Hello everyone. In this session, we are going to see CRR and SLR in detail. CRR stands for Cash Reserve Ratio. It is the mandate given by the RBI to all the banks in India to park some certain percentage of amounts of their reserves with the RBI in form of cash. The reserves can be deposits of all the deposits present and available at the bank. The deposits may be termed as net demand and time liabilities (NDTL). Okay, this is as per the section 42 under subsection 1 of RBI Act 1934. Why RBI is doing this? Why RBI is setting a benchmark to park some percentage of money with the RBI itself? Why it mandates all the banks to do this? See, banks are running not with their own funds. They are getting funds from one customer as a deposit and lending it to the another customer as a loans and advances. Okay, so here there is a critical situation may happen if the bank fails. What if the bank fails means the customer who puts their money in the bank may get lost. Okay. To safeguard the interest of the customers, RBI plays a clever role here in the Indian economy to safeguard the customers. Okay. How? We will see it with an example. For example, a customer who is going to a bank and deposited 100 rupees in his bank account. So at current rate, CRR cash reserve ratio is 4 percentage, which means 4 percentage of 100 rupees has to be kept aside by the bank to the RBI, which means remaining 96 rupees can be used by banks to lend it to lend it as a loan to the other customer, but remaining 4 rupees mandatorily has to be parked with the RBI as a cash form. Okay, why means sometimes very worst case in some rare cases the banks may fail. At that time, this 4 percentage will help the bank to revive their economy and safeguard the customers. Okay, so, what if the banks are not underlying with the RBI's mandate means hefty fine will be granted for the banks and it will be a nightmare for them because there will be a severe lash in their profit and loss account statements. Okay, so all the banks should mandatorily maintain their benchmark for CRR and SLR. SLR we will see in the next session later in this session. Now we will complete the CRR. Okay, so how CRR is going to help monetary stability in our country and how it is safeguarding the interest of the customers, we will see in the next slides. Next is SLR. SLR stands for Statutory Liquidity Ratio. It is same as CRR. The only difference is which is available in the screen in front of you. CRR is stored in form of cash only. Okay, but whereas in SLR, not only the cash, it can be gold, it can be any securities which can be easily liquidized. Those things are parked as a reserve under SLR. And one more difference is CRR is mandatorily parked with RBI's account. Banks will send the amount electronically to the RBI's account. Whereas in SLR, the banks no need to send it to RBI. They should store within themselves in the banks itself until further instructions from the RBI. So the SLR also there will be some certain percentage like 20 percentage, 18 percentage. Current rate is 18 percentage, I think. So 18 percentage of their total deposits has to be parked in form of either cash, gold, or any other securities in the banks itself. This is the major difference between SLR and CRR. Okay. Now, when the RBI releases SLR and CRR, we will see. Okay, under Monetary Policy Committee, there is a committee, MPC committee, which will be headed by RBI Governor. Actually, it has to be happened at least 4 times a year. Recently, RBI conducting 6 times in a year, which means for every 2 months it will get conducted. So that's why the name may be termed as bi-monthly monetary policy. So in this committee, they will set the CRR, SLR, repo rate, and all the rates for the benchmark setting rates for the banks, and they will get released by every 2 months. Okay. So by this committee, RBI plays a controls the credit control in our economy. We will see in the next slide how they are uh, controlling our credits. First, in first case, if the CRR is 4 percentage and SLR is 20 percentage, which means total reserve, I mean, reserve amount should be parked with the RBI is 24 percentage. CRR is parked with RBI. SLR is parked with the bank itself. So 24 percentage has to be kept aside. So remaining 76 only in the hands of banks, respective banks, for the lending purposes. Okay. Suppose next month the another committee comes, MPC committee comes, and based on inflation, I will say what is inflation. Okay, based on the country's inflation, it increases the CRR to 1 percentage, 5 percentage, and then SLR to 15 percentage, 35 percentage. So now total reserve percentage should be 40 percentage. Okay, so remaining banks will have only 60 percentage with them for their lending purposes, for giving loans. Okay, so out of 100, only 60 will be in the hands of banks. Remaining 40 has to be parked as a reserve with the as form of reserve funds. Okay, so banks, what they will do with this 60 rupees, I can't get more profit. Okay, I can't run my business. So what they will do, they will increase the interest rate for the loans. Okay, for example, previous month the personal loan interest may be 12 percentage. Okay, because that time banks have had 76 rupees in their hands, so more money, so they can lend it for lesser rate of interest, they will get profit. Okay, but today's date, as per this case, the reserve becomes more 40 percentage, so the amount with the banks, in the hands of banks, gets reduced to 60 percentage. So banks, to run their business, they will increase their interest rates for all the loans. Okay, so then only they will get their profit and can run their business healthily. So this is how RBI plays a major role in setting our interest rate for all the loans. Okay, this is how RBI controls the credit control. I mean, the amount of money that should be in the hands of people is indirectly controlled by RBI. So it helps to uh, play the, I mean, control the inflation in the economy. Inflation is nothing but, I will tell you a simple example. Today a fruit vendor may sell an apple for 100 rupees. Okay, next year, okay, the same fruit vendor won't sell it for the same price. Definitely there will be an increase, maybe 150 rupees per kg in next year. So this difference 50 rupees for over a period of year is called as inflation over the commodity. Okay, so if the inflation keeps on increasing means it is not good for an economy to grow. Okay, so RBI plays a role here by increasing or decreasing the interest which the banks giving as a loan. For example, if the all the peoples today night, in today's night, all the people in India gets credited 50 lakhs in their bank account, suppose. Okay, so next day what the fruit seller will do, everyone is having around 50 lakhs in their account, so everybody is rich. Why should I sell my apples for just 100 rupees? I will sell it for 1 lakh rupees. Okay, so likewise people will think and increase the price of a commodity based on the availability of money in the economy. Okay, so if the price of the commodity is increased to 1 lakh, the apple is 1 lakh now. Now people are fighting to get that apple. Okay, now if the people are, if the fruit seller sees the people are fighting here, so he will increase it to 2 lakhs. So the commodity of a price, the price of the commodity keeps on increasing, the value of the money keeps on decreasing, so it becomes an inflation. To control this, RBI plays the role by it is determining how much money should be in the hands of the people and in the hands of banks to control the stability in the economy. So at the bottom line, what we can conclude is if the CRR and SLR ratio increased by RBI, then the amount of money with the banks will be less. So with that less amount, banks will give loans for higher rate of interest. As a result, people like us don't prefer to go for higher rate of interest for a loan. So obviously the amount of money in our hands will be less. Okay, so this is how the inflation is being controlled by RBI. If the inflation is less, it wants to get more in the economy, RBI simply reduces the CLR and SLR ratio, then in turn the banks will have more funds in their hands. So they will give all the more funds with the lesser interest rates. So people will prefer the lesser interest rates. So finally, there will be a circulation of money in the people's hand. So this is how the circulation of money happens in India. Okay. So this is how RBI controls the inflation, the credit control in the hands of people, and the price stability of a commodity. So I think I have covered enough for this session. If any suggestions or comments are most welcome in the comment section. Thank you.